Now let's welcome our special guest, Harry Dent, author of 0 Hour and editor of Economy and Markets newsletter, which is available for free at harrydent.com. Harry, thanks so much for being back with us right here on The Income Generation.
Yeah, nice to be back.
Harry, it's great to see you again. You are one of my favorite guests to have on our show, and we interview a lot of really big national iconic people in the financial space. But you and I and Dave both know that volatility is the greatest risk to folks that are over 60 today. So what should folks do at these new record all-time stock market peaks at this stage of the market cycle?
Well, in short, get defensive. We have seen the greatest short-term run volatility to the upside ever in history in the stock market since the COVID crisis hit and stocks crashed into March 2020. So that upside move means the next move is going to be very sharply, in fact, probably the sharpest we've seen in history, and very likely over the next few months is when this could happen. So you have to get defensive as quick as you can here. This is not something most people are going to see coming.
So define defensive, Harry. So when we say defensive, does that mean liquidating and getting out and going into cash? Or does that mean buying value stocks, which might be more buoyant if the market becomes turbulent?
No, this is an everything bubble. Everything crashes. Real estate, value stocks, growth stocks, any bonds that are not treasury bonds or AAA. It's a reset of all financial assets after the greatest financial asset bubble in history. And again, it includes real estate. So you get out of risky assets into the safest. So people say, oh, gold. No, gold has bubbled up just like stocks in recent decades. It is in the commodity complex, which is very volatile and has another big downturn to come. Gold will hold up better than most commodities, but the best safe haven is good old long-term treasury bonds of the US of A. Everybody says the dollar's going to crash. I'm sorry. I'm looking at 2008, which was a preview for this crisis deeper, and the US dollar went up and the US treasury bonds were the best safe haven. And you know what? The longer the better. 30-year treasury bonds is what I'd be buying now, and I'd be getting out of stocks and real estate and higher risk bonds.
Dave, time out. Last show, Harry was calling a top of 4,700 on the S&P this year. So you want to revise that? You want to revise that, Harry? Are we going in a different direction now?
I think we could top, yes. I think we could top more at like 4,500 and between now and late July. I would say late July at 4,500 would be my best forecast. In the short term, you're always looking at scenarios and you can't predict the news and you know, that sort of stuff. But that's what I'd say, that a little lower, 4,500, and maybe as soon as late July.
So, Harry, we need to leave it there for now. I hate to cut you off because you always have so many great things to say, but thanks so much for joining us. We appreciate it.